Another set of very bad inflation numbers was released on Thursday. The headline CPI index was up 8.2% from 1 year ago, little change from the month before. Worse still, the core CPI index rose to a new 40-year high of 6.6%. These bad inflation numbers strongly suggest that the Fed is going to continue hiking interest rates very aggressively, with another 75 basis point increase in the federal funds rate likely to be announced on November 2nd. That would take the effective federal funds rate up to 3.83%. In this environment, it wouldn't be surprising if the Fed increases the federal funds rate above 5% by the second quarter of next year. Rapidly rising interest rates may be leading to a crisis in creditism. Our economic system began to evolve from capitalism into creditism 5 decades ago, when dollars ceased to be backed by gold. Saving and investment drove capitalism, but that's not what drives the economy today. Today, credit creation and consumption fuel economic growth. That's why creditism is a better name for our economic system than capitalism. The problem with creditism, and its potentially fatal flaw, is that it must have credit growth to stay out of crisis. With the Fed driving up the cost of borrowing through aggressive monetary policy tightening, it's difficult to see how credit will expand enough to prevent a severe economic slump. As the following charts will show, credit growth is already weak, and the U.S. economy has already begun to contract. GDP contracted at an annualized rate of 1.6% in the first quarter and by 0.6% in the second quarter. The chances of a much deeper recession next year are rising fast. This video will take a detailed look at the latest trends in credit growth by sector. The data is taken from the financial accounts of the United States for the second quarter of 2022. But before diving into the credit details, here's a quick overview of what creditism is.